if you look at what's driving the stocks right now, it's the fact that earnings that have been reported so far have been really strong, better than expected. And the guidance coming out of corporate earnings has also been better than expected. That's what's holding up the market right now, very close to its January highs. But that's going to last another 2-3 weeks. We'll see if there's any negative surprises coming out, although it seems unlikely at this point. But after that, people are going right back to worrying about tariffs and about the Fed. In particular, I think about the tariff issue. That has the potential to derail the markets.
It sounds like, Jack, that Q2 earnings, at least in Michael's view, might not be the broader catalyst for the markets that we hope it'll be, because we'll trade around it. We're going to have 50% of the S&P 500 by the end of the week having reported. But after that, it's back to the macro worries.
At that pack, we go back into a sort of the dynamics of news flow changes. And if you don't get company updates, if you don't get guidance updates, if we don't continue getting really good employment data on a weekly or monthly basis, then we're going to find out talking about what dominates the headlines, whether that's geopolitics, trade politics, what the potential impact of changes to Fed policy, accelerating or decelerating, might wind up meaning. And news affects emotions, and emotions affects valuation. And unfortunately, we only get earnings 4 times a year. And in between, we've got effectively 89 days of the quarter where valuation is driven by blips.
Michael, one thing we are going to get besides earnings is this GDP report for the second quarter. What's the market set up for, priced for, stock and bond market? I mean, it seems like there could be a very wide range of prints and a lot of noise under the surface.
Yeah, I've seen numbers as low as 3.6, 3.8, and as high as 5.2 for the quarter. I think it'll come in somewhere above 4. I also, don't forget, this is the period at which the government restates the last several years of history. So it's going to be very difficult for people to really figure out what the news is and what the current print tells us. I think the markets overall are looking for a mid to high 4s number and would be disappointed if they get less than that.
Just quickly, Jack, is a hot number, is that good for the markets? Or is that bad for the market?
I think we've been shifting away from bad news was good news, which gave us a very friendly Fed and very supportive evaluations, to almost good news is not bad news, because good news at least supports earnings. But good news starts making things a little bit more complicated when you start thinking about dueling mandates in terms of employment versus inflation, in terms of markets prefer predictability to unpredictability. So what's the path forward? How much will a tweet affect? How much will an interview affect perceptions of people's degrees of freedom and independence? And, ultimately, we like good news. But
By people's, you mean the Feds?
Yeah.
A variety of people.
People like Jerome Powell.
A variety of market participants having to guess what other market participants might do in response to criticism, or veiled or not.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.